Well, let's kickstart the show then and talk about a trend that we've been witnessing for the last couple of years, and that is increased investor participation, increased participation by individuals in the Lal Street, on the Lal Street. We've seen more retail investors, trying their hand at trading, at investing, perhaps egged on by the fact that, the lockdown has come into place, and that is something that has limited an individual's, outdoor activity. It's moved them as well towards other avenues of money making, and of course with the steady gains given by the Lal Street, everyone's looking in that direction, and that's clearly visible from the new demat account addition as well. Record high levels. SEBI in fact released that data that FY21's new demat account additions were at a record high level, and that in itself speaks volumes of the kind of investors that we are adding on. That's of course BSE's shared data about some of the states with the most number of investors added. But what's interesting is that Gen Z, that's the age between perhaps an 18 to 27, correct me if I'm wrong over there in the ages, but I somehow feel that these brackets keep changing. But yeah, Gen Z, or the ones who've just started off with their jobs, in their early 20s, seem to be also particularly taking a liking towards investing. In fact, not just investing, they are more than ready to try their hand at dabbling as well. More often than not, I get questions on the Money Show saying the market's very volatile and I'm too afraid to put my money in equity markets. In fact, that's usually what we hear, right? Many individuals think that, the share market is a risky place. It's, only where the bold really venture through. But here you have Gen Z, unafraid, bold, and ready to take on the risk that's involved if it shows even an indication of potential of making money. So let's analyze this entire funda and whether it's the right way for young investors to approach with somebody who interacts with both cohorts of the population, the older traditional ones as well as the new ones who are ready to tap their fingers away on the mobile phones in the hope of making quick money. Anant Ladha, the founder of Invest Aaj for Kal, joins us now on the show. Anant, it's a pleasure having you back with us on the Money Show. Thanks so much for taking out time. Anant, to start with, what do you think is emboldening all the young ones out there? I understand that you interact with a lot of them. You have your own YouTube channel as well, and I'm sure that pulls both kinds of crowds. Based on your interaction, do you think that these young ones somehow, are more emboldened to go out there, take more risks if it does give them the whiff of making more money? And what do you think is triggering that?
Hi, Mubina. See, you are absolutely right that this young generation is quite bold. But at the same time, I'm very happy to say that this young generation, or the Generation Z, which we are talking about, they are wanting to learn. I know there are still some Robinhood investors who are making some emotional mistakes, but I feel that is the way how it is. Investors, especially these young investors, have to understand that equity share market is a marathon. It is not a 200-meter race. Also, one important point is that equity share market treats you the way you treat market. For example, if you think equity share market is for speculation, there is no bigger place for speculation than this market. But at the same time, if you take it as a serious business, there is no other bigger wealth creator than this market. So we have to understand that market treats you the way you treat market. This Robinhood investors, or the Generation Z, which we are talking about, they are quite bold, but at the same time, they're wanting to learn, which is a positive point.
All right. So if you are bold, but at the same time, it's accompanied with a quest for learning, even if it's on the job, even if it's via experience, then I suppose it's a good thing. But Anant, you mentioned a term called Robinhood investors, which, we've been seeing quite a bit, hearing quite a bit. When do you sort of move into the more dangerous territory of trading then, Anant?
Firstly, if a new investor, especially a young investor, is taking some extra risk and is aggressive about his investing, that is absolutely okay if it's matching his risk profile. But at the same time, we have to understand there is a fine line of difference between over-aggressiveness, or what we call over-trading, and being aggressive. We have to make sure that there is that line we are always maintaining. And if you ask me, what do I actually mean by over-trading? No, I will just ask one simple question to all the investors, answer to which will obviously tell them whether they are overtrading or not. Suppose that you are having X amount of positions today, and tomorrow market opens 10% gap down. Will you be in a situation to take a panic-free decision? Will you be able to take a logical decision at that point in time? If answer is yes, then be calm and you are not overtrading and you are trading according to your risk profile. But if your answer is no and you will panic, then surely you should revisit your portfolio. Always sell down to your selling levels. What I mean by that is you should not have those positions which will make you have sleepless nights.
You know, Anant, what you just said right now actually echoes so well with something that noted investor Mr. Vijay Kedia had told me once, and that is invest or trade only that much money which you can afford to completely lose. Once you put money in the markets, just think of it as if this money is never going to come back. So even if you do lose it, you're not going to get sleepless nights, something similar that you mentioned. And of course, if you gain, then great, that's just like a bounty. But this is such a good way of sort of even putting it, and I think somehow it sort of resonates with what you as well said. And I think it's great that you also puts a quantitative figure out there, because sometimes qualitatively it becomes very difficult for individuals to think that, okay, am I overtrading, or am I okay? They don't even sometimes sit to think about that. But when you put a figure, it sometimes is an anchor of sorts to an individual's mind, and that makes them take more prudent decisions. Now, the last 1 year, Anant, I think would have instilled a lot of faith in a lot of individuals, because many of them have come away making good money, because in the last 1 year, we've seen the Nifty 50 rally, 50-60%. The small cap, mid cap index have done even better. So it's been a haven of sorts for a lot of investors and traders and, those individuals who've been bullish. But I mean, we just want to reiterate for our viewers that this is not forever. So in what circumstances can suddenly all of this take a U-turn, Anant? And how can these newbie investors prep themselves for that?
See, market volatility and corrections will happen every year. It is part of the complete game. Our focus should be on studying, and there's an old mythological saying that Ma Saraswati and Ma Lakshmi reside together. So we have to first worship Ma Saraswati, and we should always focus on having a proper strategy and a proper goal plus a proper portfolio according to our risk profile. And if we are failing to plan, we are obviously planning to fail. We have to first plan the trade and then trade the plan what we have actually planned. If you are scared of correction, rest assured, correction will be there, and it will be there each and every year. Correction is part of the game. And also you have to remember that correction is temporary, growth is permanent. We all know that today, but when correction actually happens, we feel that this time it is different. This time correction is due to some XYZ reason which we have not heard of, and it is very difficult for market to recover. Market will recover, faith will be required, and that faith can only come if you are having proper study and you are giving some time to study in the market.
Okay. Where do you, let's assume that, these, of course, everybody should invest their money in equity markets. It's a great way to fight inflation, etc. as well. But Anant, where do you recommend individuals to start off, in their investing journey? What people have done recently in this last 1 year started off directly by opening those zero brokerage accounts and, then executing those trades. Is that the right method? Even if they've made some good money in the last 1 year, or do you think you have to start off first maybe with equity MFs and then slowly go into investing and then maybe trading?
Absolutely right, Mubina. As you said, starting point should always be mutual funds. First, map all your goals to your SIPs and start slowly tracking them. In no way I am saying that you should not invest in direct equity. You can surely invest, but first secure your goals. And before investing directly in equity share market, first invest your money. First invest your time before investing your hard-earned money, and learn from others' mistakes. What you do by investing your time is that you are studying the market and you are studying what mistakes others are doing, and you will make sure that you yourself will not do same mistakes and cause harm to your money.
All right. So equity mutual funds versus direct investing versus trading. Who would you recommend do what kind of equity investing, since there are multiple methods now of putting your money in the large street?
See, whenever we put versus, it seems that they are competitors and enemies. In fact, in reality, they are not. I feel each investor can have allocation to all three, which we are talking about, but he should first learn. starting can obviously be done with mutual funds, and especially if there's an investor who is not having proper time, then he should obviously stick to mutual funds, and that will suffice his purpose. But if there is an investor who can spare some hours on a weekly basis, then he can surely trade into direct equity share market as well. It is absolutely okay to be using both the things, but first secure your goals and then move to the other thing. Also, if you are very new to the market, then IPO can also be a starting point for you.
Okay. All right. Well, there you have it. I hope this has kick-started our individuals and, all the young ones out there on their investment journey. Where can they start? Who is trading for? Who may not be using the right, trading methods as well? When have you overtraded? When is there room for more? I hope all of these questions have been answered by Anant. Of course, if you'd like to ask us anything more, you can always write into us on the Money Show at etnow.tv. In fact, we're monitoring our email addresses right now. So any question for Anant, shoot them to us and we'll get it answered. Okay, here's an interesting question from Ali Enamdar. He asks you, Anant, that in your opinion, what is the best style of investing right now as markets are going very high and then there's a long period of correction? So basically, markets are doing what they're doing. They're volatile in nature, and this is something that I suppose is very normal, I guess, in the life of a trader. Sometimes I think this is an opportunity as well for an individual to, make good money if you're a trader and, you're able to get the gist of how the market moves. Anant, what's your view?
Firstly, allocate your long-term goals to SIPs. Then, if you are trading in direct equity shares, be cautious, but don't be pessimistic just because market is at lifetime high. There is still a long way to go. In direct equity share, I usually say one thing: quality always comes with a price, and don't compromise with quality. Have a time-tested process and always follow it with discipline. And if you talk about style, there is no good or bad style. Every style is good style. We have to see what suits us. Just for example, we can obviously work like DMart, who are working on low margins but high volumes. At the same time, we can work like a bouquet seller who is working on high margins but low volumes. Everything works in this market. You should know what works best for you or what suits best to you.
I like the metaphor you used, DMAT, but well put, Anand. Thanks so much for that. Ali, I hope we've answered your question. Let's take on board our next query. It's something similar to what we were discussing. Shailesh Chatterjee asks, so there are all these zero brokerage trading accounts, which we of course all know of. They are one of the reasons also why we are seeing so many new DMAT accounts. But Shailesh has a follow-up. He says, I want to know what is the catch, because nothing comes for free. Should I rather go for trading services which many banks offer? He's got a fair point. There's nothing called as a free lunch, but nevertheless we seem to be seeing that with a lot of digital platforms offering free zero brokerage trading services. So is there a catch really, Anand, behind all of this, or use it since it's available rather than paying for a service, which by the way is still very much prevalent?
I personally feel using any of the discount brokers which are reputed one, there is absolutely no issues. And see, discount brokers are playing on volumes and technology instead of playing on high fees. So it is kind of a win-win situation for both investors and for the company. Banks are playing on their relationships and they are charging very high charges for that. I personally feel platform won't make much of difference. See, in a race, it is always the racer which wins, not the car which wins. So you have to be a good racer. You have to be a good investor. It doesn't matter whether you are using a discount broker or you are using a full-fledged broker. My take is always with a discount broker because we end up saving a lot of cost, and as such, there is no harm with it.
Okay, so you could say nobody offers you a free lunch, but then also you could say, why say no to a free lunch in a way? And that's what these zero brokerage and discount broking platforms are offering. So why not take it? Up until now, we've not heard any complaints or queries. Yes, there have been a few platforms that do glitch on occasion, but I suppose that's the perils of technology as well that do come along with it. Okay, I think we have time for one more question. Raj Bhandari asks us, I'm 30 years old and I started an SIP in 2017. 5,000 rupees increased it to 7,500 each per month. His goal is wealth creation. Now he has 3 funds in his portfolio. He shared his wife's portfolio as well, by the way, and she also has 3 funds, all of them very different. ABSL Pure Value, Franklin India Smaller Companies, HDFC Top 100, and his wife's portfolio is HDFC Small Cap, L&T Mid Cap, Murray Asset Emerging Blue Chip. So I presume that the 7,500 put in each of these funds is what I can understand. So in total, the couple is doing a SIP of close to 40,000 per month. Their goal is wealth creation. Do you think they've started off on the right foot, Anant?
Mubina, I personally feel that goal should always be quantified. Wealth creation is one thing, but you should always quantify it. It will obviously help you. And best part is they have started their SIPs and they have already sailed through almost 3 years or 3 to 4 years. And they have seen one volatile market. So I think they are well placed for their SIPs. Just one more addition. They are not having any of the debt funds in their portfolio. If possible, we should always have a proper debt to equity mix. I know debt will give you very low returns going forward, maybe around 5% after tax, but they will provide you, debt funds will provide you cushioning whenever market is uncertain or whenever there is difficulty in the market. So don't lose on that cushion and always have debt in your portfolio. There is one fund, Franklin Fund, which they talked about. Firstly, after there has been increase in the size of the fund, there has been underperformance. Plus, Franklin, I personally try and avoid because of the but obvious reasons which we have seen in recent part in the debt funds. And I personally try to skip that fund. Otherwise, they are well placed for their goal. They can just quantify their goal and add some debt funds to it.
Okay, so whenever you list down goals, it's always a good idea to sort of quantify it. What's the number that you want to reach? Because that'll, I guess, give you some more clarity as well and that laser focus. I understand that, wealth creation could be a little ambiguous, but maybe for more clearer goals, like if you want to buy a house or, you want to pay for an expensive education, it's even more easier in those cases to quantify. So always do that, and maybe, don't only have equity MFs, add some debt MFs too. So it diversifies your portfolio, not just in equities, but also a little bit in fixed income too. Okay, well, Anand, I think with that, we're completely out of time. We're just starting to get in some questions and queries, but I'm afraid we'll not be able to take them up right now. Anand, thank you so much for joining us on The Money Show. It's always a pleasure having you with us. Stay safe.
Thank you so much for having me on the show. Means a lot. Thank you so much.